You move to Texas to get away from the income tax, and you pay $4,564 a year more than the couple who stayed in South Carolina, a state with an income tax. Every year, for as long as you live there, not to the state. To the county assessor and to the insurance carrier that reprices your roof every 12 months. No line on any return shows you what the move cost, and no agency mails you a comparison. The no income tax map you looked at before you decided prices exactly one of the 4 bills a retired household actually pays. It says nothing about the other 3, and nothing at all about the 5th line, which never arrives as a bill. This is not a closing cost you pay once. It is an annual bill, and 2 of those 4 lines climb on their own schedule whether your income moves or not. 25 years of that gap, with no inflation added at all, is more than $114,000. In the next 15 minutes, you get one household's whole annual bill in all 4 states, line by line, and the income level where the answer flips. And you will see why the real ranking is not a ranking of states at all. It is a ranking of your own house against your own income. And by Part 4, you will know which side of that line you are standing on. I am your guide to the retirement numbers that quietly decide where you can afford to live. Start with the one line the whole map is built on: state income tax, because for a lot of retired couples, it is smaller than they expect. Often 0. The large majority of states do not tax Social Security benefits at all. And in South Carolina, the taxing state we are about to price, a resident who is 65 or older may deduct $15,000 against any kind of income. For a married couple, $30,000. That is an ordinary IRA withdrawal, gone before the state rate ever touches it. So I did not take anybody's ranking. I priced 4 states, one line at a time, using the Tax Foundation's own state figures for the lines the map leaves out. Quick favor before Part 1. If that sounds worth 15 minutes, tap like and subscribe so the next one finds you. Part 1. The couple and the line that is already 0. Jean and Patty are both 67. Their house is worth $400,000 and it is paid off. Between them, they collect $48,000 a year of Social Security and they pull $30,000 out of a traditional IRA. $78,000 of retirement income. Not a poor household, not a wealthy one. That is the point. On the Tax Foundation's 2026 rate tables, 8 states levy no individual income tax at all: Alaska, Florida, Nevada, and New Hampshire, plus South Dakota, Tennessee, Texas, and Wyoming. New Hampshire joined when it repealed its interest and dividends tax in 2025. Washington gets colored in too, and is left out only because it taxes capital gains separately. That is the map. One color, one message. Keep more of your income here. Now run their income through it. No tax background required here. We take this one line at a time, slowly. Half of their Social Security, $24,000, plus the $30,000 from the IRA gives $54,000 of provisional income. That is the number the IRS uses to decide how much of a benefit becomes taxable. Half the benefits, plus everything else coming in the door. $54,000 is above the $44,000 joint threshold, so $14,500 of their benefit becomes federally taxable. Add the withdrawal, and their adjusted gross income is $44,500. Their deduction stack for 2026, with both spouses 65 or older: $32,200 of standard deduction, plus $1,650 for each of them, plus the $6,000 senior deduction each. $47,500. $44,500 of income against $47,500 of deduction. Their federal taxable income lands at 0 before we get anywhere near a state, which means South Carolina, colored on the map as a taxing state, collects nothing from them either. It does not tax Social Security at all. and that $15,000 deduction begins in the year each spouse turns 65, $30,000 between them, exactly the size of that withdrawal. 4 states, first line, 0, 0, 0, and 0, including the one the map warns them about. Now the 3 bills nobody puts next to it. Part 2. The 2 bills that never read your tax return. Property tax first, because it is the largest and the least discussed. The number that matters is the effective rate, what owners in that state actually pay, expressed as a share of what the home is worth. On the Tax Foundation's 2026 figures, Florida, 0.78%, Texas, 1.4%, Tennessee, 0.52%, South Carolina, 0.49%. On a $400,000 house, that is $3,120 a year in Florida, $5,600 in Texas, $2,080 in Tennessee, $1,960 in South Carolina. Texas has no income tax and charges them $3,640 more than South Carolina, which does. That one line alone is larger than the income tax the map was warning them about. 2 honest caveats, and they cut both ways. These are statewide averages, so your own county can sit well off its state's number, and senior programs move your line. South Carolina exempts the first $50,000 of fair market value on a legal residence at 65, and Texas adds a school district homestead exemption and freezes the school tax bill at that age, which means none of that is in the totals I am about to build. Every property tax figure here is a statewide average before any age 65 break, and Texas has the more generous over 65 package of the 2. So at a real address, the Texas gap is narrower than what you are about to hear. Narrower, not gone. And it is exactly why the last thing I ask you to do is price your county instead of your state. Second bill, the homeowners premium. On the Insurance Commissioner data the Insurance Information Institute publishes, the average premium for a standard homeowners policy in 2021 was $1,411 nationally. Florida, $2,437. Texas, $2,146. South Carolina, $1,432. Tennessee, $1,368. And that is the old picture. By 2023, Florida's statewide average had reached $3,340 on figures from the Industry Institute and the Florida regulator. This line is not converging. It is spreading. I am still carrying the 2021 numbers into the totals because they are the last set where all 4 states come from the same table, measured the same way. Mixing years across states is how comparisons start lying. That choice does one thing. It makes Florida look better than it is. Hold that until Part 4. Here is what those 2 bills have in common, and it is the whole argument. Neither one asks what you earn. A retired couple with no paycheck pays the same assessor's bill and the same premium as the neighbor pulling $300,000 a year. Income tax is the only line here that shrinks when your income shrinks, which is exactly why it is the wrong line to move for. Part 3. The 4th bill, and the line that is not a dollar amount at all. Sales tax. Combined state and local averages for 2026. Florida, 7.02%. South Carolina, 7.49%. Texas, 8.19%. Tennessee, 9.61%, the second highest in the country. The national average sits at 7.53%. Say Jean and Patty spend $30,000 a year on things that are actually taxed. Taxable purchases only, not the whole household budget, since groceries and services are treated differently state by state. Florida, $2,106. South Carolina, $2,247. Texas, $2,457. Tennessee, $2,883. Look at what Tennessee just did. Cheapest property tax of the four, no income tax, and the largest sales tax bill in the group. A strong answer for a retiree with a big house and modest spending. A mediocre one for a retiree who rents and spends. Same state. Opposite verdicts. A colored map cannot tell you which one you are. That is all four bills. Here is the fifth line, the one that never arrives with a price tag. Whether you still have a choice about your health coverage once you get there. Medicare itself is federal. Your ability to buy a Medigap policy later is not. Federal law gives you one 6-month guaranteed window when you first enroll in Part B. After it closes, in most states, an insurer may look at your medical history before deciding whether to sell you a policy at all and what to charge. On KFF's state-by-state table of Medigap protections, only 4 states, Connecticut, Massachusetts, Maine, and New York, require continuous or annual guaranteed access for everyone 65 or older in traditional Medicare. 15 states and the District of Columbia offer nothing beyond the federal minimum. None of the 4 states here is on the short list. Others have added something narrower, a birthday or anniversary window to switch a supplement you already hold. Useful. But trading one policy for another is not the same as buying your first one after your window has closed. That matters more than it used to. On KFF's 2026 enrollment update, 55% of eligible Medicare beneficiaries, 35.2 million people, are in Medicare Advantage, and those plans run on local networks. Cross a county line, and the plan you were happy with may not follow you. Whether you can then move to traditional Medicare with a supplement is decided by the state you moved to. Every other line on this list is money. This one is access, which is why it never shows up in the total. It is not a cost line. It is a veto line. You can budget around a premium. You cannot budget around a policy an insurer declines to sell you. Part 4. The total and the number where it flips. 4 lines, 4 states, 1 household, 1 year. Florida, nothing in income tax, $3,120 in property tax, $2,106 in sales tax, $2,437 in insurance, $7,663. Texas, nothing, $5,600, $2,457, $2,146, $10,203. Tennessee, nothing, $2,080, $2,883, $1,368, $6,331. South Carolina, the one with the income tax, 0, $1,960, $2,247, $1,432, $5,639. The state that taxes income is the cheapest of the 4. It beats Florida, the symbol of American retirement, by $2,024 a year, and Texas by $4,564. And Texas is on the map. And remember the insurance year. Those totals carry Florida at its 2021 premium. Swap in Florida's own 2023 average, only Florida's, since the other 3 have no matching update in that source. And Florida's bill climbs about $900, losing to South Carolina by closer to $3,000. Call it a stress test, not the table. But notice which direction it moves. Now the part that decides whether any of this applies to you, and it is the piece worth writing down. South Carolina's top rate is 5.21%, so work it backwards. A top rate shortcut, not a filled-out state return, which means the real crossover sits a little higher than what I am about to say. Before Florida can catch South Carolina, that income tax line has to grow to $2,024. That takes roughly $39,000 of South Carolina taxable income after Social Security and both age 65 deductions come out. For a household living on Social Security and an IRA withdrawal, that is a long way up. For a household with a large pension on top, it is not far at all. To catch Texas, the same line has to reach $4,564, roughly $88,000 of taxable income on this house. Add the benefit and the deductions back on top, and you're describing a household well north of $200,000 of retirement income before Texas stops losing. So the rule is not avoid the states that tax income. It is a ratio. The larger your house is relative to your income, the more the map misleads you, because your bill is dominated by two lines that price the house and ignore the income. The larger your income is relative to your house, the more the map starts telling the truth. A retired homeowner living on Social Security and a modest withdrawal is usually standing on the first side. The map was drawn for the second, and those two lines keep climbing after you stop working. The assessor revalues, the carrier reprices. Neither one cares that your withdrawal rate is fixed, so a state's rank is not a property of the state. It is a property of your house, your spending, and your income. And the tax the map ranks is usually the smallest of the four you will actually pay. So build the bill yourself before you sign anything. 4 numbers and 1 phone call. Pull the effective property tax rate for the county you are moving to, not the state average. Get a real insurance quote on the actual address before you make an offer. A statewide average has never paid anybody's premium. Multiply your honest taxable spending by that county's combined sales rate. And ask what your Medigap options look like in that state, in writing, while you're still healthy enough for the question to be theoretical. This is education, not financial advice, and not legal advice. Your county, your roof, and your income are all specific, and a fee-only advisor or a CPA licensed in the state you are considering can price your version of these 4 lines in an afternoon. And if this changed the way you read one of those maps, tap like. It puts this in front of the next couple about to move for the wrong reason. Subscribe if you want the rest of these numbers before you need them. Then type the word MAP in the comments and add the state you are weighing. If enough of you name the same one, I will build the full bill for it. See you next time.